Hello. This short video explains the significance for gold and the dollar of the new oil futures contract priced in yuan, which started trading last Monday. There is little doubt that the Chinese government views this contract as important. It has long been China's intention to settle international trade in her own currency, the yuan, instead of dollars. Doubtless, China will in time insist she pays in yuan for more of the key commodities she imports. But for her commodity suppliers to accept yuan, they must have access to a range of financial instruments. The Oil-Yuan contract is an important step in this direction. However, China is aware that replacing the petrodollar with her own currency risks pushing the dollar lower and possibly much lower. This is why she has proceeded cautiously. To appreciate why the dollar is vulnerable, we must understand something called the Triffin dilemma. Robert Triffin held that the country which issues a reserve currency has to run trade deficits to ensure there is a satisfactory supply of the reserve currency. In other words, an unsound economic policy can, for a period of time at least, be accompanied with an overvalued currency. There is a common but incorrect assumption that this can go on forever, ensuring demand for the reserve currency will always support its value. Not so. As Professor Triffin pointed out, it is a short-term expedient that creates a long-term problem. That is the dilemma. At some point in the future, there will be sufficient currency in foreign hands to meet everyone's needs. This could come about because enough currency is in foreign hands already, and more currency will simply undermine its purchasing power. Or perhaps global trade contracts, so less reserve currency is needed. Or, alternatively, perhaps a rival currency for trade settlement emerges. The country issuing the reserve currency must then bring its trade deficit back into balance, or even into a surplus if the currency is to maintain its purchasing power. Now let's apply this knowledge to the dollar. Just at the very moment when the role of the petrodollar is being compromised by the new yuan contract, and the world is already awash with dollars, thanks to post-crisis monetary expansion, President Trump is increasing the budget deficit and consequently increasing the trade deficit. The outcome is that over the next few years, the foreign exchanges will be awash with overvalued dollars. Meanwhile, gold exchanges in Asia are aware the new oil for yuan contract is likely to encourage some oil exporters to China to consider selling some of their yuan for physical gold by buying matching gold futures in either Hong Kong or Dubai. These rival exchanges are planning to team up to increase their joint capacity to deliver and store bullion with a new vaulting facility on the Chinese mainland. Furthermore, they're bringing in Singapore and other centres in Southeast Asia to give their project more muscle. So we can see two broad outcomes from the introduction of the new oil for yuan future, both of which are bad for the dollar. First, there's likely to be more buying of physical gold later this year by the central banks of some of China's oil exporters, notably Russia, Iran, and perhaps Qatar. This serves to drive the gold price up, measured in dollars, which is bound to lessen confidence in the dollar itself. And second, the dollar is likely to face a significant decline, possibly a crisis similar to the one that collapsed the London gold pool in the 1960s, as overvalued and unwanted dollars are dumped on the foreign exchanges. The failure of the dollar at that time forced President Nixon to abandon the agreement to swap gold for dollars in 1971. And that was the last time we saw the dark side of the Triffin dilemma. With different actors, the situation for the dollar today rhymes very clearly with those events of 50 years ago. Thank you.